So friends, the discussion that we did so far, from that discussion we can conclude that the components of BOP statement, they include number 1 the current account transactions, number 2 capital account transactions, number 3 reserve account, that is the foreign exchange reserve, then errors and omissions. So these are the 4 major categories of the component as far as BOP statement is concerned. Now we will discuss each one of them in detail. Before that, let us see this statement from the Economic Survey 2019-20. So the latest economic survey that was released in the month of January 2020. So from that survey we can see the first item is current account. Inside the current account we have export, we have import, and the net difference of export and import comes out to be trade balance, right? Then we have invisibles. Inside the invisibles we have services, we have income, we have transfer, and the goods and services balance. Then we have current account balance. Then inside the capital account we have external assistance, we have external commercial borrowings, we have short-term credit, banking capital, and non-resident deposit, foreign investment, FDI, portfolio, other flows, errors and omission, overall balance, finally reserve change, increase or decrease. So in this you can see that in the latest economic survey this format has been there, and this is what we have been studying so far. So this format is basically coming from the Economic Survey 2019-20, and this is the format that we are discussing right now. So if we want to define balance of payment, so the definition has been given by Kindleberger. So this person has said the balance of payment of a country is a systematic record. So this is a record of all. So all here means both the private sector transactions and the government sector transactions. Record of all economic transactions between the residents of the reporting country. So in our case it can be India. So between India and residents of foreign countries during, so this account is belonging to a particular period of time, during a given period of time. So normally this is annual and also quarterly, right? So we are calculating this on an annual basis as well as on a quarterly basis. It is a double entry system of record. Double entry system, that means there will be entry both on the debit side and the credit side. All economic transactions between the residents of the country and rest of the world carried out in a specific period of time. When we say a country's balance of payment, we are referring to the transactions of its citizens and the government, right? So this point means that we are referring to all the economic transactions, whether these transactions are done by the private sector or by the government sector. So the transactions done both by the private sector and the government sector, we are including both kind of transactions. Next, what are the important features of balance of payment? First of all, it is a systematic record of all economic transactions between one country and rest of the world. It includes all transactions, including visible as well as invisible. It relates to the period of time. Generally it is on an annual basis. It adopts the double entry bookkeeping system. It has two sides, credit side and debit side. So please be attentive over here. Please understand this thing very carefully. So it adopts a double entry bookkeeping system. It has two sides, credit side and debit side. Receipts are recorded on credit basis, right? So credit side means the receipts, and the payments are recorded on the debit side. So payment basically means the debit side. So both sides are very, very important. Both sides are are to be considered, then only we call it a double entry system of accounting. Now, what is balance of trade? So balance of trade is nothing but the difference between export of goods and import of goods. So the difference between export of goods and import of goods, this difference is called balance of trade. So the difference between country's imports and its export, balance of trade is the largest component of a country's balance of payment, right? So this balance of trade, this is also called as the balance of merchandise trade. When exports are greater than imports, so when exports are greater than imports, then balance of trade or BOT is favorable, right? Favorable means this is also called as surplus. And if imports are greater than export, if imports are greater than exports, then this is unfavorable, or we also call it deficit. Now, what is the difference between balance of trade and the balance of payment, right? So I am discussing these small topics because there is a possibility that questions can come from these small topics. So the balance of payment takes into account all the transactions. All means whether current account or capital account. In the current, whether visible or invisible. So all the transactions are taken care of. All the transactions are taken care of. The balance of trade takes into account all the trade transactions with the rest of the world. So here the trade of goods, that means the import and export only, right? So balance of trade is a component of the balance of payment. So here we can see the difference between balance of payment and balance of trade. Balance of trade, it is a very broad term because it includes all the transactions, whether they are visible, invisible or capital. This is a narrow term because it includes only visible items, only and only visible items. It always balances itself, right? So balance of payment, it always has an impact of 0 because if there is deficit, then foreign exchange can be paid. If there is surplus, then foreign exchange can be increased. So in any case, foreign exchange can be adjusted and balance of payment is always balancing because the payment is equal to receipt or debit side is equal to credit side. So in any case, they will be balancing. Just like the balance sheet of any entity is balanced, similarly this balance of payment is also a kind of balance sheet of the country. So this is also a kind of balance sheet of the country and this has to balance itself. Now, balance of payment is equal to current account plus capital account plus minus balancing item, that is error and omission. In case of BOT, it can be favorable or unfavorable, and BOT is equal to export minus import. Now, what are the main factors behind the BOP? First of all, conditions of foreign lenders. So foreign lenders, if foreign lenders are good, then they can supply a lot of capital into the country. Economic policy of the government. So if the economic policy is to attract FDI, to promote export, to reduce import, then that will be reflected in the balance of payment. All the factors of BOT. Since BOT is part of the BOP, therefore all the factors of BOT always become part of the BOP. Now, what are the main factors which affect the balance of trade? First is the cost of production, right? So, before discussing the factors, let me ask you, in the balance of trade, there are two items. One is the export, another is the import. So, what are the factors which can impact the volume of export and import into India or from India? So, they can be impacted by prices of goods. If the prices of goods are available, which are the goods which are available outside India, the prices of those goods are very less, then we will import. If it is a reverse case, that is, the price in India is very less as compared to the world, so in that case we can export, right? So that price will be dependent upon cost of production. So cost of production is dependent upon labor cost, interest cost, and other production costs. Second is availability of raw material. Third is exchange rate. Fourth is prices of goods manufactured at home. Following are the main factors which affect BOT. One is cost of production, another is availability of raw materials, then we have exchange rate, and then we have prices of goods manufactured at home. So these are the BOP versus BOT transactions. Now, what is the importance of balance of payment? So we have been discussing this term so much. Why at all we are discussing this term? Why at all this is so important? So the importance of balance of payment. First of all, BOP records all the transactions that create demand for and supply of currency. So we can actually see that from where the currency is coming and to where the foreign currency is going. So here the currency basically means foreign currency, right? So the demand for foreign currency arises because of the import. If we know that how much is the import, we can actually plan that in the next 1 year how much currency do we need. So here I would like to take an example of 1991 BOP crisis. So in 1991 there was balance of payment crisis. At that time we had the foreign exchange reserve only equivalent to the payment of just 2 weeks import. So then we declared that we are in crisis, because if we default in paying the foreign exchange dues, then we will be called defaulter country and we will not be getting any amount as borrowing from anybody in the world, right? So coming back to this, BOP records all the transactions that create demand for, that is import, and supply of, that is exports. Judge economic and financial status of a country in the short term, right? So what is the economic status? What is the financial status? If we are doing good, then there should be BOP surplus. If we are doing bad, then there are chances that BOP deficit will be there. If we are doing good on front of the export, then there will be current account surplus, and vice versa. The BOP may confirm trend in economy's international trade, right? So whether international trade is increasing, whether international trade is decreasing, what is the share of India in the total exports of the world, what is the share of India in the total imports of the world. So that trend can be seen. And exchange rate of the currency. Why our exchange rate is increasing? Is it because of the high demand or is it because of the less supply? Why the cost of imported goods is increasing or decreasing? So all these trends we can see. This may indicate policy shift of the monetary authority of the country. So depending upon the BOP deficit, depending upon the condition of export, the RBI or the monetary authority, it can decide its policy. How is that? We will see in the subsequent slide in this session only. Now, general rule in the BOP accounting. First, if a transaction earns foreign exchange, right? Earns means we receive the foreign currency, then it will be considered to be credit item and it is recorded as a plus item. If a transaction involves spending means if a transaction involves spending of foreign currency, it is a debit and it is considered to be a negative item. So very, very simple. Receipt means credit or plus. Spending or payment means debit or negative item. So this is very, very simple funda. So coming back to the various components of a BOP, right? So first component is current, then we have capital account, then we have reserve, then we have errors and omissions. Now let us come back to this diagram that we discussed, right? So we have current account. Inside the current account, we have visible item. Inside the invisible item, we have services, income and transfers. Now let us see the current account balance. The current account balance. So what is the meaning of current account balance? The transactions which impact the income and expenditure side, which are short term in nature, which are single way or one way transactions. So BOP on current account is a statement of actual. Please be careful. As I already discussed, this balance of payment indicates actual transactions, actual receipts and payments in short period. It includes the value of export and import of both visible and invisible. There can be either surplus or deficit, right? So in this diagram we can see overall there is a possibility of both surplus and the deficit in the current account. So there can be surplus in the current account or there can be deficit in the current account. So both possibilities are there. So it includes the value of export and import of both visible and invisible goods. They can be either surplus or deficit in current account. The current account includes export and import of services, interest, profit, dividend, unilateral receipts, payment from tour abroad. BOP on current account refers to the inclusion of three balances: the merchandise balance or balance of trade, services balance and unilateral transfer balance. Now India's top 5 trading partners. So this thing I have taken from the economic survey of 2019-20. The top 5 trading partners. First of all, what is the meaning of trading partner? Trading partner means any country with whom we are doing the export and import, right? Now how do we determine top 5? For determining top 5, we take the total amount of export and import. So we add the total amount of export and import which India has done with a particular country. Total amount of export and import which India has done with a particular country, and we compare that with the total foreign trade of the country, of the India, right? So the total, for example, we take about USA. So for example, India's total foreign trade or India's total export and import is 100 rupees. Now out of this 100 rupees, the value of total export and import done with the USA is 11.3. So this comes out to be 11.3% in case of USA. Similarly, China, UAE, Saudi Arabia, Hong Kong. You just need to remember USA is the top or largest trading partner. Second largest is China and third largest is UAE. So we have USA, we have China and we have UAE. Now what are India's top 5 import items? First is crude petroleum, second is gold and third is petroleum products. You should always know top 3 items: crude petroleum, gold and petroleum products. India's top 5 exports: petroleum products, precious stones and drug formulations and biologicals. So these are the 3 topmost export items. You can see petroleum products are in the first place as far as export is concerned, in the third place as far as the imports are concerned. Now current account balance. If the trade balance is positive, this is called favorable balance of trade. If the trade balance is negative, this is called unfavorable balance of trade, or this is also called as trade deficit. This is also called as trade surplus, right? And this is basically, we are talking about visibles only, right? So this thing we are talking about the visibles only. So coming back, these two are basically visibles. Then we have invisibles. So invisibles record the receipts and payments with respect to A, services, B, income, C, transfer. Services or non-factor income. So export and import of services, also called as non-factor services or non-factor income. Income from investment, profit and income generated through employment, right? So we have interest, profit, dividend, salaries, etc. Right? So this income is basically representing factor income, right? I am moving a little bit speedily because I have already discussed all these points earlier. So just consider that this is a kind of revision for you. At the same time, don't skip the session, right? So don't think that you have already covered everything. There are few points which will keep coming in between the discussion itself. So my recommendation is that you should not skip this session. Don't think that you have already covered, so you can skip this session. Even if you know everything, still you can consider that this is happening. This lecture is a basically revision part. Transfers includes gifts, grants which do not have any liquid pro quo. So there is no reciprocal transaction, there is no quid pro quo. This is called transfers or unilateral transfers. Now let us see the trade deficit as a percentage of GDP. So this orange bar indicates trade deficit as a percentage of GDP. This data has been taken from the latest economic survey of 2019-20, which came on the 31st of January 2020. So if we see the trade deficit, this trade deficit in the year 2011-12, this was approximately 10% of GDP, right? So this kept declining. And the lowest was in 2016-17 to the extent of approximately 5%. So in 2016-17 this was just 5%. But why? Because in 16-17 the crude oil prices were declining. The crude oil prices were very, very low. So this was a very favorable situation. After that there has been increase, and finally in 1920 we are expecting it to be around 7%, between 7% to 8%. Another aspect is net services as a percentage of GDP. So net services as a percentage of GDP, if we see this in 2011-12, this is approximately 4%, and there is almost similar trend, and here in 16-17 there is a decline. So overall net services to GDP ratio is not much changed, but it has been declining over a period of time, which is a cause of concern. So net services as a proportion of GDP reflects the net impact of service exports and import on BOP, right? So net services basically reflects the export of services and minus import of services. So this is net services. India's net services surplus. So there has been surplus. That means the receipts from the services have been more than the payment for the services. It has been steadily declining in relation to GDP, right? So this is a cause of concern. We really need to look into that. What is the problem? What is missing? Then the surplus on net services has been significantly financing the merchandise trade deficit, right? So on the net services there is surplus, in the merchandise trade there is a deficit. So this surplus has been compensating this deficit. Given a steady decline in the net services to GDP ratio, the extent of financing will steadily fall unless merchandise trade deficit improves in relation to GDP. Now, current account. Current account balance is equal to trade balance plus invisibles balance. If the current account balance is positive, it is called favorable current account balance, also known as current account surplus. If the current account balance is negative, it is called unfavorable current account balance, also known as current account deficit. Now, what are the causes of current account deficit? Please listen to this discussion very carefully, because this part has not been covered so far. So, if we talk about the causes of current account deficit, why current account deficit is there? So, before we start discussing, let us understand what are the components of current account. So, in the current account, we have the visible. Inside the visible, we have export and import of the goods. That is one thing. So what are the factors which impact the goods trade? What are the factors which reduce the export? What are the factors which increase the import? So we have to look upon that, right? So what are the factors which reduce the export? The quality, the poor quality of export, high prices of production. So we have high logistics cost. The economic survey says that logistics cost in India is approximately 13% to 14%, but the average of world average is just 10% of the GDP. So logistics cost in India is very high. Because of that, the cost of production increases, and because of that increase in the cost of production, there is increase in the export price, and because of that our export is not that much attractive in the world market. Right? So this is one thing. Why import is high? Because we are a developing country. We need technology, we need machinery, we need capital. Our consumption is increasing. We are becoming more Western oriented. So because of that, there is a lot of import also. So import is increasing, export is not that much increasing. This is on the side of visible. Now coming to the invisible. On the invisible side, what are the factors which are impacting the service sector? What are the factors which are impacting the unilateral transfers? What are the factors which are impacting the factor income? So first of all, what are the factors impacting the services sector? So in India, we have been very good provider of the outsourcing and the software services. But because of the financial crisis which started in 2008 and which finally resulted into the world of protectionism, where every country, especially the big countries like USA and UK, they want to protect their own manufacturing and the services sector. So they have put a lot of restrictions on the import of services from the country like India. So this protectionism is impacting the services. Another problem is that the neighboring developing countries like Bangladesh, we have Malaysia, Indonesia, all these countries are basically becoming the new competitors in providing the low cost services. So India's USP has been that India was providing low cost services for a long time. That because of that only we became the net service provider. But because of the competition which we are facing from the neighboring countries, they are also able to provide the low cost services to the developed countries. There has been adverse impact upon the services, right? So that is about the current account invisibles part. Now, whatever factors we have discussed, overall we can divide the factors into two categories. One is the structural factor, another is the cyclical factor. Structural factor means that in India's economy there is a structural problem which will take long time to recover, which will take long time for the government to take a step for, right? Another issue is So one category is the structural, another category is the cyclical. Cyclical means they are there but for a very short cycle. So cycle can be for a period of 4 years, 2 years. So those are the temporary issues, and those temporary issues can be resolved immediately. So when we divide all the factors into structural and cyclical, it gives an opportunity for the government to look into that which steps can be taken immediately and which step can be postponed, right? So government action plan can be started, the government action plan can be formulated and implemented based upon whether the factor is structural or cyclical. So for the structural factor, the long-term impact, the long-term steps will be taken. For the cyclical, the short-term steps will be taken. Now coming to the structural causes. So structural causes include, first of all, underinvestment. Our infrastructure is very, very poor. We are not able to provide cost-effective electricity. The condition of road is very poor. So because of all that, the cost of production increases. Relatively low productivity. Our labor is not that much skilled, right? There is huge rigidity in the labor laws. So because of that, the labor productivity is very, very low. Not only the labor productivity, but also the technology productivity is also very, very low. Persistently high relative inflation. We have been facing this inflation problem for a long time because of the supply side constraint. Our agricultural infrastructure is very, very poor. Rural roads, rural godowns, rural markets, agricultural markets, all these the storage system, distribution system, processing, everything is very, very weak. Because of that, there is high inflation of raw material. When there is a high inflation of the raw material, it increases the cost of production. When there is increase in the cost of production, it leads to the general rise in the price, which is nothing but the inflation. Inadequate R&D and innovation. In India, our expenditure on research and development and innovation is very, very poor. Not only the expenditure, but the focus upon the research and development has been really poor. Emergence of lower cost competition, right? So as I told you that we have started facing the low cost competition from the neighboring countries like Bangladesh, Malaysia, Indonesia, and other Southeast Asian countries. So these are the structural factors. The government should take more investment, it should liberalize the labor laws, it should focus upon the inflation targeting, it should spend more amount on the research and development, and it should try to reduce the cost as far as possible. So all these steps will be taken for a long period of time. These are the structural issues. Now coming to the cyclical issues. What can be the cyclical issues? So cyclical issues, first of all, exchange rate. Exchange rate can be one thing. If